All right, and everyone is coming through now.
We got wires that go into the security panel here.
Oh, here we go.
Oh, we're in.
Yes. Hi all, you're in. It's David here from Brighter Super. We'll just give everybody a minute to join and then I'll start. If everybody doesn't mind putting their phones or laptops on mute, that would be great.
Take it outside, fucking pull it apart, give it a hose, let it dry.
Okay, I think most people have now joined that were joining. We had one of these sessions yesterday, so another one today. Welcome everybody. My name is David Loy. I work with Brighter Super. The session today is a defined benefit refresher session. Hopefully it'll be of benefit to you and I'll be able to explain to you how your benefits work. Before we start, I'd just like to do an acknowledgement that Brighter Super acknowledges traditional owners of the land on which we are meeting today and pay our respects to elders past, present and emerging. We acknowledge and celebrate the continuation of living culture that has a unique role in this region. And one other piece before we start, the presentation provides general information only. It has been prepared without taking into account your individual objectives, financial situation or needs. You must not rely on the information alone as a sole or primary source of advice or guidance for the purpose of making decisions about your superannuation options. If you wish to make any changes to your super, you should obtain a copy of and consider the relevant PDS, which is product disclosure statement, and target market determination and seek any financial advice before making decisions. Those documents can be found on the Brighter Super website. The web address is down there, /about us, /governance, PDS and guides. There's also a financial services guide there for your information. Okay, so today is about defined benefits. Before we start, I'd like to introduce you to Laura Hall. Laura is a colleague of mine. Laura will be moderating today and answering any questions that you put through to the chat. So Laura, if you'd like to introduce yourself.
Sure. Thank you, David. I will be moderating our chat today. So from a bit of housekeeping purposes, there will be a bit of time set aside for questions at the end. But if you do have questions throughout the presentation, please feel free to drop these into the chat. I will respond back to you through there. And then if we need some further information, we can always chat about it live. So please do hold off on any questions till the end or pop them into the chat as we go through. Thank you.
Okay, thank you. So just a bit of background on myself. David Loy, I've been working for Brighter Super now for nearly 2 years. I've been in the superannuation industry for 30 years. I've been working on superannuation funds and defined benefit funds all that time. For my sins, I'm also a qualified actuary, though I don't do actuarial work anymore. I do relationship work. So I'm the corporate relationship manager for Energy Queensland and work with your HR and payroll departments on an ongoing basis, sometimes daily. But today is all about defined benefits, and our agenda for today is a few things. How's your benefit calculated, which I'll go into some detail. What happens when you leave? Do you need advice? And then what next? So I'll run through each of those now. Please pop questions into the chat box to Laura if you think of any as you go. Laura had a lot of questions yesterday, so she'll keep up to any questions you've got. Okay. How does DB work? And there's some terminology that is relevant to defined benefits that doesn't apply elsewhere. So I thought I'd go through that terminology first, just to make sure we all have a good understanding of what the items mean. So first one is final average salary, or known as FAS, F-A-S. It's your average superannuation salary over the last 12 months. So relevant when you leave, it's the previous 12 months before you leave. Any benefit quote that you see online or on a statement relates to the 12 months leading up to that date. So the date of the statement or the date of the quote. We get reported salaries from Energy Queensland twice a year, on 31 March and 30 September. We receive them sometime after those dates, and we update our system. So any quotes you see online or any quotes you see on a statement will be linked to those salary information that we have from EQL. When you come to actually leave, we go back to EQL and get the full salary history for the previous 12 months. So please rest assured that even though you might see something that might be slightly different to what you expect online or on a statement, it will be based on your full salary history in the 12 months leading up to your exit as a defined benefit member. There's another term called concessional contributions. This relates to the contributions made by your employer, Energy Queensland, and any personal before tax contributions you make yourself. They're called concessional contributions. Anything that's not pre-tax or not by your employer is known as a non-concessional contribution. Yeah. We can hear some people talking. If you don't mind putting yourself on mute, please. Sorry. Thank you. Concessional contributions have a cap of $30,000 a year, and I'll go into a bit of detail about how that works shortly. There's a term called a reserve. This applies to people who leave defined benefit or cease employment before the age of 55. When the calculation is done under age 55, there's a discount factor applied to the benefit, and I'll explain that as we go through. That discount factor is 2% per annum. There's another term called a notional contribution. This is a term that confuses many people, and this is particularly relevant at the moment, given that Energy Queensland have announced to staff that they're going on a contribution holiday for defined benefits. So I'll spend a little bit of time on this one. The notional contribution is the amount that we have to report to the ATO as the administrator to the fund that relates to the contributions paid or theoretically expected to be paid by Energy Queensland as to finance your defined benefit. So what happens is every year, and this has been going on for many years now, is we report an amount to the ATO, not based on actual contributions paid by the employer, which can vary from time to time, but based on a notional contribution rate, which is provided to us by the actuary. The actuary to the fund is a professional who is assigned to do calculations for the fund and the trustee in relation to the cost of funding the benefit. And the actuary provides a certificate each year or on an ongoing basis that tells us what we need to report to the ATO as being the cost of the employer providing your benefit. And as I mentioned before, it doesn't relate to the actual cost that the employer physically pays. So at the moment, the employer is just commencing a contribution holiday. Despite the fact that the employer is not paying any money to the fund, we still have to report to the ATO the cost of that benefit accruing on a year-by-year basis based on the factor provided to us by the actuary. And so I'll give you an example. On your statement for last year, there will be an amount shown on the statement that says the employer contributions paid. That will be based on the factor provided to us by the actuary, not the physical amount paid to the fund. And last year, it was 13.2% of salary. From 1 July this year is 14.4% of salary. So we will be quoting and sending to the ATO a figure equal to 14.4% of the salary provided to us at 1 July as the employer contributions for the year. And I'll reiterate, despite the fact that EQL are paying nothing. So some of the questions I've had from defined benefit members over the last week has been, because EQL are not paying now, does that mean I can contribute more towards the cap of 30,000? And the answer is no, we will still be reporting 14.4% of your salary to the ATO. Added to that will be any contributions you make yourself that will count towards the cap. If you have a salary that takes 14.4% of your salary above the $30,000 cap, we report $30,000 to the ATO, not 14.4% of your salary if that exceeds the $30,000 cap. So that's an important point to note, so that don't be thinking just because EQL are on a contribution holiday that there is an additional amount that you may be able to top up. Please put a question into Laura if you have anything that you don't understand about that, and we'll try to answer at the end. There's another part of this that is linked to some of you. Potentially there is a additional tax called a Division 293 tax that applies to high income earners. Some of you may have received a Division 293 tax payment request from the ATO in the past. It applies when your income as assessed by the ATO exceeds $250,000, that income includes the contributions that we report to the ATO as being your notional contribution. So, for example, if you earn $240,000 and then we add to that the 14.4%, that will take it above the 250. The bit of your contribution, the 14.4% that takes it above the 250,000 is assessed at an additional tax rate of 15%. Now, I know it gets confusing when you start to receive these additional tax requests from the ATO, but it applies to everybody when their income exceeds the $250,000. So again, if you've got any questions, please put them through to Laura. It is a topic that I've spoken to a number of DB members about at a personal level. If you've got any questions, please feel free to email me or call me and I'll happily have a conversation with you about it at a personal level. But you need to be aware that it's based on the notional contribution factor that we send to the ATO, which for this year will be 14.4%. The next item is the member benefit multiple. So this is the factor that we apply to your final average salary to calculate your benefit. And for most people, it's your entire membership period. So when you joined as a defined benefit member, times 19.5% or 0.195. There may be some members where for a period many, many years ago, the factor was different, but certainly going forward from this date and for many, many years, it's been 19.5%. So you should be able to look at your statement, divide your multiple by the number of years you've been a member, and you'll get 19.5% as the factor that's being used. So they're the terms that are relevant to your defined benefit. There's a couple of additional components of your defined benefit that I'd like to explain before we actually get into some example calculations. So what happens to the money when it is paid by you? So you as a defined benefit member pay 5% of your superannuation salary to the fund as the cost to you of being a defined benefit member. And Energy Queensland pay whatever is required to top up the benefit to make sure that there is sufficient funds for your benefit to be paid as and when defined benefit members retire. That's the contribution paid by the employer. It goes into what we call a defined benefit pool. So that plus your 5% contributions goes into a pool. That pool is invested. Brighter Super manages those investments, and those assets that sit behind there are used to pay out benefits as and when defined benefit members retire. The calculations that we do are based on 3 separate calculations for you as a defined benefit member, and I'll start to talk about those shortly. The important point to note is that defined benefit pool, all the risk is governed by or taken by the employer. So if markets fall, then the employer is required to pay additional funding in there to top up the assets to make sure there's sufficient funds there. Conversely, when markets are performing well, like they have been, employers may be able to go on contribution holidays and not pay money into that pool because there are already sufficient funds in there, as is the current case. On top of the pool and the amount of money that the employer and you contribute, you may yourself also do additional contributions, or you may have rolled money in from another fund. Those monies go into a separate accumulation account that is for you as a defined benefit member. You have investment choice over where that money is invested, and that account balance relates directly to you. So the risk on that money is borne completely by you, as opposed to the pool money, which is borne by the employer. You can make investment decisions over where that money is invested, and you can top that up at any point in time. Okay, so the calculations that are used for your benefit. So there are 3 calculations that occur each and every time a defined benefit member leaves the fund or decides to retire. So the first one is a simple calculation, which is 2.5 times your member account balance. So the member account balance is the money, the 5% that you put in as the cost of being a defined benefit member. That's invested in the pool at the investment returns that are earned by the pool, and that grows on an annual basis until you hit age 55, and that amount is then fixed at age 55. And the calculation just becomes 2.5 times that account balance at age 55. If you're under 55, the account balance grows until you reach age 55. So that's the first calculation that's done. We then add to that any additional monies you've got in your accumulation account, and that forms the option number 1. Option number 2, which is by far the most common benefit paid to defined benefit members when they leave, is your final average salary times that member's benefit multiple that we talked about before, which is the 19.5% for each year you've been a defined benefit member, and your final average salary is your average over the last 12 months. If you're under age 55, it is multiplied by a discount factor of 2% for each year you're under age 55. So, for example, you're age 53, it would be 96% of final average salary times members benefit multiple. We add to that your accumulation account, compare that to number 1, the greater of those two is then the higher benefit that would be paid. But we also do a comparison to item number 3 there, or option number 3, which is a complicated calculation known as the minimum requisite benefit, or simply the MRB. This is governed by a certificate that is again produced by the actuary based on a formula provided by the actuary. And the idea of this calculation is it's meant to be a proxy to what you would have earned as an accumulation member had the company been paying superannuation guarantee contributions into an account for you. The only difference is that account is assumed to earn money at the rate that is earned by the defined benefit pool, so it doesn't take into account your own personal investment choices. But it is meant to replicate or be a proxy for what you would have got as an accumulation member who had been paid the superannuation guarantee from when the superannuation guarantee first started back in 1992, plus whatever you had accrued to that date in 1992. So as an example, the way it works is somebody's been around since 1985. The first 7 years, the benefit is the same under the MRB as it was as a defined benefit member. From 1992 onwards, it then becomes 3% as the SG started in 1992, increasing to 4, 5, 6, etc., all the way up to where we are now at 11.5%. That will then stop once it gets to 12%, unless legislation comes in to increase the 12 to a higher amount. The MRB does not include the more recent increase to accumulation contributions up to 12.75 and now 14.75. It is based solely on the superannuation guarantee contributions that are currently payable to most accumulation members around the country. We then add to that your accumulation account balance, and we compare options 1, 2, and 3, and the highest value out of those 3 is what is paid to you as a defined benefit member. I'll go through a couple of examples just to make it crystal clear as to how it works, but hopefully that gives you an understanding of how the defined benefit works. You can see for yourself how those calculations apply to you. There are a number of ways of doing it. Your annual statement that you receive and you would have received recently sets out all 3 calculations and shows the benefit. The front page gives you the highest of the 3, but further into the statement, you can see how each of the 3 calculations is done. You can also get a real-time quote online. So if you go into the online and go down the left-hand side, there's a benefit quote spot. Click on there and it will produce for you a current quote. Again, setting out the high level calculation, the highest of the 3, and then the 3 underlying calculations. So you can see the difference. For the majority of you there on the call and defined benefit members, it will be option number 2, the final average salary times the member benefit multiple. There are only a handful of people, I understand, where the MRB applies or may apply in the future. And that's mostly because the 19.5% multiple has been around for many, many, many years, whereas the SG has been gradually working its way up to its current level over the last 20 years. So it started at 3 and worked its way up. So for many, many years, the MRB was significantly lower than the final average salary calculation. Just bearing in mind that the quote online is always an estimate. It is based only on the salary information we have for March and September. So if you've had any changes in between those dates or more recent, it won't take that into account, but it will do when the final benefit is paid. Okay, an example. So we've got Joe. He's 63 and decides to retire. He doesn't want to work anymore. He joined on his 29th birthday, so he's got 34 years as a defined benefit member. 34 times the 0.195 produces a multiple of 6.63. We've used a final average salary calculation of 65,000, which I know for most of you is probably not relevant in today's climate, and you're probably on a significantly higher amount. However, that's what's in the product disclosure statement. So to be aligned with the product disclosure statement we're using the $65,000 example. This will just give you an example of how the calculation works. Assuming the member's Joe's got a $50,000 accumulation account balance and his member account balance at age 55 was 69,000. The actual calculation that we do for all three of them is on the screen there. So the 2.5 times member account produces 172,000. The final average salary calculation produces a 430,000, and the MRB produces 321,000. And I know there's quite a lot of disparity between those three, but that is common amongst defined benefit members. So in this instance, calculation 2 produces the highest figure of 430,000. Add to that the 50,000 that's in the member's accumulation account balance, Joe would receive 481,826. And that would be the benefit that would be payable to Joe. We have quite a lot of questions around the benefit itself and what happens if circumstances change. So I thought I'd cover those now as well. So one of those circumstances is what happens if you, as you get closer to retirement, decide to change roles, take a lower paying role, go on part-time. So I'll cover those now. So what happens if you take a lower paying role? There is a clause within the trust deed that protects the final average salary calculation and crystallises it at the date you take a lower paying role, and then rolls it up forward thereafter at the Australian Workers Ordinary Time Earnings rate that's quoted annually. So it's sort of your salary is then crystallised at that date you go to the lower salary, and your benefit is not impacted by you taking that lower paying role. Your future payment will not be based on that lower paying role. It'll be based on the final average salary as it was at the date you took the lower paying role, rolled forward with those awarding increases. What happens if you go on part-time? So if you go on part-time, let's say you reduce your hours from 100% to 50%, then that factor, that 19.5%, we multiply that by the pro rata rate, so the 50%. So your future accrual of that factor, instead of being 19.5%, would be 50% of 19.5%. So your benefit grows at a slower rate, taking into account the fact that you're only working 50% of the time. Another question is what happens if I take leave without pay? So if you go on leave without pay, effectively, you're not accruing any benefit at that point in time, unless you reach an agreement with Energy Queensland whereby your contribution, that 5% plus the employer contribution, is paid throughout that period of leave without pay, and that's up to you and EQL as to how that's negotiated. If those payments continue while you're on leave without pay, then your benefit will continue to accrue as it otherwise would have, assuming you weren't on leave without pay. But those payments need to be negotiated and paid to the fund for that period. The other question is what happens if your employer's on a contribution holiday? I think I addressed that before, but the employer stops paying to the fund because there are sufficient funds to keep the benefits going and being paid at that point in time. The actuary reviews that to make sure that's still relevant. If you take leave without pay and the employer happens to be on a contribution holiday at that time, then nothing needs to be paid from the employer's side to the fund. Only your 5% contributions would need to be paid to the fund to make sure your benefit keeps going. Okay, an example of Joe, he decides to go on part-time hours for the last 2 years. So the same Joe retires on his 63rd birthday, but for the last 2 years, he goes on part-time of 80% hours of his full-time. So the calculation option number 2 changes slightly. We have only 32 years at the full-time, 19.5%. Then there's 2 years at the 19.5% times the 80% factor. And his multiple now becomes 6.552 rather than the multiple it was before. And you can see if I go back to scenario 1, when he was on the full-time hours, his benefit was 430,000. It's reduced slightly to take into account that reduced hours in the last 2 years and now becomes 425,000. So nothing happens to the past. So the accrual that you've built up to the date you make the change stays in place. It's just the future years that is impacted by the change in hours, and it's only that factor that's impacted. We still use the same final average salary, so we take a full-time equivalent of your actual earnings, use the full-time equivalent, so the FAS doesn't change. It's only that factor that changes. Okay, so they're the calculations. As a defined benefit member, there are some additional benefits that form part of your benefit. Same as an accumulation member, there are insurances that sit behind your benefit. These are automatically included as part of your defined benefit. First one is temporary disablement benefit, or also known as income protection. If you're an accumulation member, it's referred to as income protection. As a defined benefit member, it's referred to temporary disablement benefit. We had a question yesterday about going online. It says income protection 0, but underneath it says temporary disablement benefit, and it shows the figure. So please don't be confused between the two. They effectively mean the same thing. They just have a different term. You can get additional income protection if you so like. That would be something you would apply for yourself. You would need to answer personal questions about your health, and that can be set up for you, assuming you qualify and can go through to age 65. I just would like to point out here that recently, through EBA negotiations, EQL has taken out a separate income protection policy paid for by the company outside of super. So you may find that you have income protection or temporary disablement benefit across 2 policies. You cannot be paid from 2 policies. Now, both of those policies are being paid for on your behalf by Energy Queensland. So there's no cost to you of having them, but you will not be able to claim against both. So one would be offset against the other. You would receive a payment, but you cannot get more than the equivalent of 80% of your salary paid across the 2. There's also a death and total and permanent disablement benefit paid as a defined benefit member. The death benefit would be paid to your personal representatives or your dependents, and the TPD would be paid to you in the event that you're assessed as being eligible for TPD. Those calculations are based on the benefit that you would have received assuming you made it to age 60. So this assumes you're under age 60, say you're age 55 when you pass away or meet the TPD definition. We assume, or the calculations assume, that you have made it through to age 60. The factor that we use is based on the fact that you would have made right through to age 60. So that 19.5% assumes that you've gone to age 60, and we use the salary that applies at the date of your passing or the TPD is approved. Okay, that's your benefits. What happens when you leave? So there are a few things to consider. The first thing is, how does it work? So you make the decision to retire, change employers, get a new job. You notify Energy Queensland that you're leaving. Energy Queensland will then notify us to say, Joe has decided to retire, wants to take his benefit. Joe will be retiring on this date. So we are then notified by Energy Queensland. We then have to wait until the final contribution that relates to your last fortnightly pay period comes through to us, and then do the calculations. That whole process generally takes around 4 to 6 weeks. In that time, your money will be then transferred to an accumulation account, and you can then make decisions over what you want to do with that money. You will need to make some decisions around, how is that money invested? Do I still want insurance, etc. So on the screen here, you can see investment changes. So what happens when that money is transferred across? The defined benefit components. So if you remember, there was a defined benefit component in Joe's case, which was 430,000, and then there was an additional accumulation component of 50 grand. The defined benefit money is invested in cash. You then have to make a decision after that point whether you want it to remain in cash or not. But we move the money across to cash. So please be aware that it will be invested in cash when it's moved across. If you've currently got accumulation money and it's invested in either the smooth return investment option or the capital guarantee investment option, that money is moved out of those options because they're closed options and moved to either MySuper or cash, depending on which one it is. If you've got it invested in any other option, it will remain invested in those other options. So the key one here is that your defined benefit money, which is the bulk of the money, will be moved to cash, and you will need to make a decision as to how you want that invested once it's transferred across. There's also a decision around insurance. So your insurance as a defined benefit member can be continued as an accumulation member, but you have to notify us within 30 days of ceasing your defined benefit that you want to continue that insurance into your accumulation account. If you do that within 30 days, it just automatically continues across. As a defined benefit member, those dollar amounts will carry over into your accumulation account. If you don't do it within 30 days, then you can apply for it, but you would need to be assessed for insurance as you would be if you were applying for additional cover. So it is important to take note of those 30 days, and if you want the insurance to continue, then, and you would do that based on a decision that you've made with your financial advisor. Presumably you've sit down, you've decided to retire. Do you need insurance or not? And if you do, then you need to make the decision within 30 days. Okay, what are the options when you do decide to leave? So number one, you might choose to leave, but you want to carry on working. So you've left Energy Queensland, you want to work with a new employer. You can choose to leave your money with Brighter Super in an accumulation account, retain your insurance if you want it there, make your decisions around your investment options, provide a choice form to your new employer, and the money would just be paid going forward to Brighter Super. That's option number one. Your new employer will have its own default fund as well. You can make decisions around what you want to do with your money, but you can certainly leave your money with Brighter Super and have your future contributions continue to be paid to us. You may choose to retire and set up a pension account. Brighter Super can also accommodate that. The minimum amount you need to start a pension account is $20,000. You can choose to invest all or part of your money in your pension account. You will need to make choices around how is that money invested. You'll need to decide how often you want the money to be paid. You may like to align it with your payments prior to retiring so that you receive it on a fortnightly amount. You may not be able to match what you're receiving as a salaried employee. You'll make decisions around how much you need in retirement and presumably do that in consultation with a financial advisor and work out how much you can draw down. There are minimum amounts that the government sets that you need to take out of your pension fund, and that's because it's in a tax-free environment. So generally, when you retire at age 65, it's 4%, and the percentage gradually increases as you get older. I think it goes to 5% when you're in your 70s and gradually works its way up to 10, 11, 12, 13% as you get older. One of the key ages to consider is age 60. So once you get to age 60, all money in a pension fund is tax-free. So the investment earnings on that money is tax-free. Any payments are all done under a tax-free basis. So it is a tax advantageous environment to have your money in a pension fund after age 60. But that is a discussion you'll need to have with your financial advisor. Another option you've got is taking some of the money in cash. When you make a decision to leave your employer, albeit through resignation or retirement, in order to take any money as cash, you have to meet what's called a condition of release. When you're retiring, making a decision to retire is deemed to be meeting a condition of release so long as you've met your preservation age. Now, preservation age for anybody who was born before 1 June 1964, you will have already met it. If you were born after 1 June 1964, it's age 60. So it's important to know what your preservation age is. I was born in 1963, so my preservation age was 59. I've already met that because we've passed that point in time. So I could choose to retire tomorrow. In most of your cases, you could choose to retire if you're past age 60 and take a cash withdrawal because you're deemed to have met a condition of release. If you're under your preservation age, then you're not able to take a cash withdrawal unless you meet a condition of release for some other reason, like disability or something like that. But that's a separate conversation with a financial advisor. If you want to access your money via cash, you need to complete a withdrawal form. You will need to provide some certain identification and a bank statement so we know where to pay the money to. So there are certain steps you need to undertake if you want a cash. But you can do a combination of cash and pension, etc. That's entirely up to you once you've decided to retire. Okay, a question we always get is, do I need advice? The answer, in my opinion, is yes, but it depends very much on how old you are and at what point, what stage you are in your retirement journey. The advice you might want prior to age 50 is certainly just how am I tracking, how are things going, and age 50 beyond, how are things going? Am I invested in the right way? Am I contributing enough money? So Brighter Super offers services called Super Health Checks. We run these all the time. We come to your workplace and run them. We can also do them online. You can go online and book one tomorrow. I highly advise doing so, especially as a defined benefit member, because it's more complicated than an accumulation style and benefit. We can also help you with what's known as intra-fund advice, where we actually hook you up with one of our financial advisors, and you can talk about the level of contributions you need to make, the level of insurance you might have, what investment options you're in. And both the Super Health Check and an intra-fund advice, as they're known, They're at no cost to you. We can organise them at any time, and please contact us and set something up, and one of our team will be happy to have a conversation with you. Once you get to age 50 and beyond, we recommend you do something called a retirement health check. There is a small cost to that, small depending on your point of view. It's $330. It will look at the path that you're tracking towards retirement and whether you're deemed to be what's termed as being on a comfortable retirement path. So there is a phrase known as comfortable retirement. It's a phrase set by the Australian Superannuation Funds Association. It deems the amount of money that you need to have in retirement to live what they term as a comfortable retirement. If you come to us and we can set that up for you, and we can give you an indication of whether your current benefit puts you on track to receive to be on a comfortable retirement path when you deem to decide to retire, which might be after age 60, 65, depends on you. So there's a cost of that. Once you get to age 60, then we recommend you have a little bit more detailed advice. There's a term called scaled advice. This is advice about taking a pension. So should you or should you not take a pension? When you do, how much should you invest? How should you put your money? What investment options should you put your money in? How often do you take your money? How much should you draw down on your benefit? There is a cost of that of $990. That's specifically for people who want to look at a pension option. It gets even more complicated if you have additional financial instruments, maybe a family trust, you might have other investments, you might have other super, you want advice that's more comprehensive. That is something that you can set up with us as well. There is an additional cost of that, and that is negotiated with the advisor based on the complexity of your financial situation. So they're all the types of advice that can happen. Please give us a call if you would like to understand or discuss any of those. We can set something up. Certainly recommend having a super health check as an absolute minimum, or advice around your contributions and investments, because they're for free and we can set them up at any time. If you want more information on them, please go to brightersuper.com.au. Okay, the question's around how can advice help? It can certainly help with your identifying cost of retirement, how much you're going to need, as discretionary amounts, how much you're willing to spend. Do you have enough to retire? What sort of investment portfolio do you want to set up with your superannuation money to try and accommodate your requirements in retirement? You may have estate planning, so you may have dependents, you may have been married before, you may have children from different marriages, you may want to set certain things up to accommodate payment of your entitlements out to your beneficiaries in the event of your passing. You may want to have discussions around how does it work with Centrelink benefits, how do the two intertwine, how much money can you have in super and yet still be able to claim Centrelink benefits, etc. And what sort of level of insurance cover do you need, if any, once you decide to leave work or in retirement? So these are all the questions that you need to ask, and that's how financial advice can be of value. Okay, that's what I wanted to discuss today. Laura, has anybody been asking any questions online that you think we need to address? Or if anybody's got any questions, please speak now.
I do actually have a really great one that's come through the chat, and I thought this would actually be amazing to answer in person, because there is a couple of scenarios for this. So I had a great question on what is the value for a comfortable retirement figure. So Brighter Super actually work with one of our regulators called ASFA, and they actually survey current retirees each and every quarter to say, what are you spending your money on and how much is these things costing you? So we work with that, and then we create a bit of an estimate as to how much either a single person or a couple might need in retirement for a comfortable lifestyle. So for a single person, if they would like to retire around the age of 60, they would need approximately $509,000 in a balance. If they were willing to hang off until the age of 65, that drops down to $366,000. And then for a couple, again, looking around the age of 60 of retirement, that balance for the two of them combined looks like roughly 1.1. And then again, if they're willing to hang off until the age of 65, that drops down to $975,000 for the two of them. So hopefully that gives you a bit of an idea on what they look like. If you want to dig into that a little bit in more detail, you can Google ASFA retirement standards. So Association of Superannuation Funds of Australia, so ASFA. You can do that and have a look at the actual workings that go into some of those figures. Bearing in mind, ASFA will generally start their figures about the age of 67 because that lines up with the age pension. So those figures at the age of 60 have been done with some brighter super calculations as well, but it gives you an idea on how the system works. And there's a couple of other questions that have come through in the chat as well. So a really good one from Wes. Apologies if I pronounced that wrong for you. Does Brighter Super offer any sweeteners or benefits to members when transitioning to a pension account? So we do have what's called a retirement reward for our members, which you can just simply search on the website. And it is essentially a little bit of a bonus to transition into retirement or go into an income stream once you've retired with Brighter Super. So it is a bit of an extra additional cash benefit that's paid into that account. However, for defined benefit, it's somewhat complex. So I would suggest reaching out to us to help us calculate that for you. But if you do have a spouse who is in accumulation, that would apply to them as well. So any questions on that, jump onto the website, search up retirement reward. It explains how it works and how it's calculated. But yes, we do have that. That's recently come through in the past couple of years. And a question from Stephen, is leave loading included in your final annual? So your final average salary is generally considered your fixed remuneration. So if it's included in your fixed remuneration and it's part of your contract, it's potentially considered as included in your FAS. The example I like to give as, if someone was doing some overtime during storm response, potentially that's not included because that's not fixed remuneration on your contract. But unfortunately, Brighter Super can't give information on, yes, this is included, no, it's not, because we're not aware of what's detailed in all of your employment contracts. So my number one tip is to have a chat to Energy Queensland about what is included for your individual circumstances, and that way you know going forward what is and what isn't.
Hey, Laura, it's Dave. I can assist with this one. So this is a question that has been asked, this leave loading, by a number of defined benefit members.
Perfect.
And I can tell you that Energy Queensland are currently considering as to whether it would be included or not. So I think Energy Queensland will be, I can't guarantee they'll be making an announcement, but they'll certainly be informing employees as to whether it's included or not, because they certainly are aware of the question that's been asked.
Great. Thanks, David.
Any other questions, Laura, or from anybody else?
I'm just having a bit of a scan through. There we go. Another one from Wes. Where does Brighter Super sit in relation to the other super funds, as in a rating? So for our current ratings, we've just had our, we've done very, very well with our balanced and our growth. So over the 5-year term and the 7-year term, which is generally where we like to think about superannuation, because it is a longer term investment. So the year to dates and year on year can change quite dramatically from one year to the next. But our 5 and our 7-year returns on our growth and our balance have actually come in at number 1 according to Super Ratings, which is the independent organisation that runs all of our ratings nationwide for all of our funds. So that is something we're incredibly proud of, is that longer term really strong performance. And oh, you guys are all over the questions. You're a bit too fast for me. I'm trying to keep up. Okay, so how much is currently sitting in the EQL DB fund surplus in dollars, not percent? David, are you aware of that information?
I don't have the dollar figure to hand, but you can find out the dollar. So I'll tell you what's happening at the moment. So the last actuarial valuation was done at 1 July 2021. That valuation report is currently available online, so you can go and see what the amounts were in 1 July 2021. You go down to governance at the bottom of our web page and click on reports and documents, I think it's called, and go in there, and it's got a valuation at 1 July 2021. It'll give you the figures in that report broken down, not just with Energy Queensland, but across all the GOCs, and give you the total and percentages and dollar values, etc. There's currently the 1 July 2024 valuation is being done at the moment by the actuary. The actuary has until 31 December to complete that report and deliver it to the trustee. Once that report has been signed off, it will also be available online and will give a more up-to-date figure as to what's the current position is. So the last known position we've got is back in 1 July 2021, where the actuary looks at circumstances over the period between valuations, because they do valuations every 3 years, and assesses whether another valuation is needed or not in that period. For example, if there was to be another global financial crisis like happened in 2008, in between valuations, that would trigger the requirement for an immediate valuation assessment of the fund. So the actuary is currently doing one at the moment, and will be available early in 2025 online. The other thing that's also available online in that same place is the certificate provided by the actuary that sets out how that MRB calculation is done. It's known as a benefit certificate. It's sitting in the same place online. If you want to, it is a long, complicated certificate setting out the formula, but you can see for yourself how the MRB is calculated. So those documents are available online.
Thanks, David. Another little quick question that came through. What is the minimum amount of dollars required in the accumulation fund to keep it open? This can change from time to time. So I would always suggest, if that's if you're looking to withdraw some funds or to move some funds out of accumulation into income stream, to chat with us at that current point to find out what the amount is. But I do believe at the moment it's about $8,000.
Yeah, that's correct, Laura. It's 8,000 at the moment. So, but that's when you decide to move all your money to accumulation. As a defined benefit member, you can have zero in an accumulation account because you've already got your defined benefit. You don't. There will be defined benefit members out there with no accumulation account because they haven't contributed additional amounts over the period. It's only once you crystallise your defined benefit and go to an accumulation account that you need to keep that minimum balance of $8,000, or that at its current level, which is $8,000.
Perfect. And one question that I did miss, my apologies, Paul. When we first, I'm going to read the question for David's benefit as well. When we first signed up to DB, one of the options was to be paid a percentage of final average salary for the rest of your life. If you were on a multiplier of 8, then it was 75% of your final average salary post-tax dollar, assuming that is no longer an option. I'm not aware of that arrangement. As I'm aware of the rules within defined benefit, essentially your FAS goes towards calculating your benefit, and then your benefit will last as long as it lasts, depending on how much you're drawing down, what the market movements are, those kinds of things. David, are you aware of anything else?
No, there's no facility within our trustee that I'm aware of that facilitates that lifetime pension, which is effectively what that member's referring to. That will be a very old arrangement that must have ceased at some point in time. I honestly don't know the history, but those type of arrangements are closed for a long, long time, and defined benefit funds no longer pay percentage of final average salary as a pension going forward. They're just lump sum amounts. So I can't give you the history as to when that no longer became a available benefit, but it certainly isn't available at this point in time.
Thank you. And one quick question, which is probably easier to answer than type an answer to. DB is from Glenn Dolan. DB is a guaranteed figure, which is great. However, I've been reading that some DB members are moving to DC after 55 and speak about it being better off. Is there any truth to this, or is it a financial advice question? Obviously reliant on markets and carry some risk. Absolutely spot on, Glenn. So that is what I would highly recommend, getting some financial advice, because it may be better off for someone and it may be better, it may be worse off for another person. So one of the key components is that you are then bearing that risk. So if, for example, you do move out of defined benefit and then we see another market crash, obviously you're the one bearing that risk. But, in terms of when the markets are great, there can obviously be some decent earnings that come along with that. So any member that I get, I do a lot of field work and I do a lot of face-to-face. So anyone who comes to me and says, hey, I'm considering moving into an accumulation account for the last part of my working career, I'll say, great, I think you should get some financial advice on that, just to make sure that it's the right decision, because that is something that cannot be undone. Once you are out of the defined benefit product, you cannot get back in. So we want to make sure that that's right for you.
I'd just say, Laura, it is a question that's been commonly asked by defined benefit members at the moment, because EQL has increased the amount they're paying to an accumulation member to 14.75%. So it's a common question now among defined benefit members. So advice is key.
I'm just typing another answer to a question. How long does it take to move to accumulation? Generally, we say to allow about 4 to 6 weeks for this process to be finalised, for a couple of reasons. To allow for any further contributions to come through from your employer, to allow for a final average salary calculation to come through from the employer as well, and then for us to get that crystallised in our system. So generally, on the safe side, we've got a track record of getting it done quicker than that, but just because if anything goes askew, we say 4 to 6 weeks for that to be processed. Another question. In 2002, EQL distributed a portion of the fund surplus to DB members. Is some or all of the surplus going to be distributed to members soon? David, did you want to field that one?
Yeah, absolutely. So that is 100% a question for EQL. Brighter Super is the administrator of the fund. We would act under instructions from EQL. EQL being the entity that finances the benefit, it is definitely a question for them. It won't be a surprise if you ask the question, because others have also asked the question. I have been sent a copy of a document from 2002 that set out how the distribution of surplus was done in 2002. So HR at EQL are certainly aware of the questions being asked, but it is absolutely a question for EQL to respond to. And I'm not passing the buck there. It's not a decision that Brighter Super or the trustee could make.
And the last question that's come through is, how much needs to be contributed to a spouse account to gain the government co-contribution? So I'm just going to do a bit of clarification on that question before I answer it. So there is a spouse contribution type and there is also a government co-contribution type. They're two different things and they both have different benefits. So it's important to have a think about your individual circumstances before deciding which one applies. And there can be scenarios where you can actually take advantage of both. So a spouse contribution, very quick explanation, is generally a contribution made by a higher income spouse to the account of a lower income spouse to receive a tax offset for the high income earner and obviously boost the balance of the lower income earner. So the cutoff for that contribution is the spouse needs to earn less than $37,000 for the full tax offset or $40,000 for a partial tax offset. The government co-contribution is different. It's actually not the spouse contribution. It's just a voluntary after-tax contribution that can attract an incentive payment from the government. The high income bracket for that is, I think off the top of my head, about $57,000. But there is a great, for both of those contribution types, for spouse and co-contribution, I would highly encourage jumping onto the ATO website, because not only are all of the figures there from a cap perspective, as in how much the spouse or low income earner can earn, but particularly on the spouse contribution, there's a fantastic calculation. So the ATO actually splits out how it works, how the tax offset's calculated. It's fantastic. So I would strongly suggest jumping onto the ATO website, searching up spouse contribution, searching up government co-contribution, having a look at the rules, because you may be actually able to do both.
Hey, Laura, I want to cover two questions we were asked yesterday, because they may or may not be relevant to the people on this call, but we were asked yesterday about taking long service leave, and when you're on long service leave, spreading that leave out by going on 50% pay. So if you've got 3 months leave, you can extend it to 6 and be on 50% pay for that period of time. The question was, how does that impact your superannuation? And the other one was a similar thing. If you're in the Army Reserve and you go on an extended period with the Army Reserve, how does that impact? I have asked the question of Energy Queensland as to how that will work, because basically when we change your benefit as a result of information provided to us by Energy Queensland. So if Energy Queensland said the member is now on a part-time fraction for the period of time when they're either on the Army Reserve leave or long service leave, then we would adjust the benefit accordingly. If Energy Queensland has reached an agreement with you, the member, around your long service leave and your Army Reserve leave, and it's fully funded, then they wouldn't advise us of any change, and your benefit would continue on as though you were on full time. So it's definitely a question to ask HR at EQL if either of those circumstances applies to you.
Great pickup, David. Now we are just about running out of time. Something I also wanted to mention as well is that if you have any questions that come up later, this is certainly not a one-shot deal. We're always happy to answer questions as they come through. You're obviously more than welcome to buzz the 1-800 number for our contact center. If you have an account manager, by all means, reach out to them as well. But you can also utilize that email address that came through with the initial communications as well. So drop an email through. If we can answer it, we absolutely will. Or if it's a question for Energy Queensland, we'll let you know that as well. But if you do have any more that pop up after today's session, please do get in touch with us and we will help you out.
Yeah, and Laura, I'm going to put myself on the spot here, but if all else fails, feel free to contact me. I work with Energy Queensland. I work with Brighter Super, but I'm in contact with Energy Queensland all the time. I'm the relationship manager between Brighter Super and Energy Queensland. I've worked on defined benefits for many, many years. So if all else fails, you should have my contact details through this invite. Please send me an email and I'll happily have a conversation with you. If it's not there, it's david.loy, L-O-Y, @brightersuper.com.au. Okay, Laura, anything else before we wrap up?
No, that is all of the questions. Okay,
so I just wanted to quickly finish off with letting you know there's a defined benefit guide available online. So in the same place that we talked about where the forms and that reports, there's a defined benefit guide there as well. Please access that if you've got any questions that you may have. You may be able to find the answers in that guide. It'll also give you examples of how the calculations are done in the same way that I've done today. But please access that. Please make a booking with us if you would like to have a super health check or talk to one of our advisors. We will happily talk to you. If you end up getting comprehensive advice, that'll be a discussion that you have with us and we'll book that in with you at the time. We do come to the workplace, so if we're ever there, please utilise our people that come to the workplace and have a conversation with them or give us a call. Hopefully you've got out of today what you were hoping to receive. Look, if you've got any questions or anything, then please contact us or contact me and we'll do our best to help you. Thank you all for attending today and we'll talk to you soon.
Thanks, guys.
Thank you.